We're jumping straight into the iShares Silver Trust today. Everyone is watching the price action, but the real story is the secular bull market that has silver testing $80.
It really is. I mean, it's a fascinating moment. We're seeing this convergence of monetary history and futuristic industrial demand that, honestly, we haven't seen in decades.
And the numbers are just, they're loud, they're screaming at you.
Yeah.
You know, we spend so much time on this show obsessing over tech stocks. Everyone's looking for the next AI play, right?
Or which chip maker's going to win.
Exactly. But while everyone was looking left at the NASDAQ, this ETF, the iShares Silver Trust, has just been quietly ripping higher on the right. We are talking about a one-year return of nearly 148%.
It's actually 147.86% to be precise.
Okay, so nearly 150%. That's wild. That's effectively doubling your money and then, adding another 50% on top, all in an asset people usually think of as, I don't know. Boring. Yeah, something your grandfather buys coins of and buries in the backyard.
It's definitely not boring right now.
No kidding. And looking at where we are now, February 2026, the fund is already up over 11% just year to date. This doesn't feel like a simple trade anymore.
No, it feels like a movement.
It does. People are rushing into hard assets.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
Me too. And, you said it perfectly. Is this a bubble or a breakout? That's the question. We need to look at the physical metal market versus just the paper trade.
That's the key.
Right. And that's what we're going to do. We'll unpack the bull case, the bear case, and everything in between. But before we get into the weeds, if you want simplified market insights like this delivered daily, make sure you subscribe and hit the like button. It really helps us out.
It does.
Okay, let's get into it. The bull case. Why on earth are investors piling into physical assets right now? Is it just fear?
Fear is part of it, for sure. But it really starts with the performance engine itself. You mentioned those returns, which are, impressive. But we need to look at the net asset value, the NAV.
Okay.
As of February 10th, 2026, the NAV reached $74.55.
So for those listening who might not be ETF geeks, break that down. Why does the NAV matter more than just the share price?
Well, the NAV is the true value of the silver held in the vault divided by the number of shares. If the share price drifts too far from that, you aren't really getting a fair price for the metal.
Got it.
But that $74 mark is a huge jump from a year ago. And that 2025 performance, that massive return, it didn't happen in a vacuum. You have to see this as a secular bull market.
Secular meaning long-term. Right. This isn't just a flash in the pan.
Exactly. A cyclical market moves with the business cycle, maybe a few years. A secular market can last a decade, maybe more. And this surge is being driven by this really potent cocktail. On one side, you have the monetary factors, people losing faith in currencies. But on the other, and this is the part I think people miss, is the industrial demand.
This is where the tech angle comes in, isn't it?
It is. Silver isn't just money. It's the most conductive element on the periodic table. You literally cannot build the green energy transition without it.
Solar panels.
Solar panels, they just devour silver. And the contacts on the chips driving the AI revolution, silver. So you've got a situation where supply is flat, mining is tough, but demand from these huge growth sectors is exploding.
So it's a supply crunch. Are we running out of the stuff above ground?
We are burning through the stockpiles, yeah.
Yeah.
And that fundamental tightness, it creates a floor under the price.
Which explains this really interesting psychological shift I'm seeing, this buyable dip mentality. We saw a recent correction, right? A pretty sharp one.
We did. It was about 30%.
Whoa. Okay, pause there. A 30% drop. In most sectors, if you drop 30%, people are running for the exits.
Oh, yeah, they're screaming, crash.
They're calling their brokers in a panic. But here, the market saw it as a reload zone.
That's the difference between a real bear market and a correction inside a bull market. When you see a 30% drop get absorbed that quickly, when buyers step in that aggressively, it just signals this really strong underlying conviction.
They weren't panic selling, they were bargain hunting.
Exactly.
That takes a serious stomach, though. But I want to pivot to the structure of this fund, because we're not talking about futures or a mining stock. We're talking about the iShares Silver Trust. Why is this specific vehicle the safety play?
It really comes down to what you aren't buying. When you buy a mining stock, you buy a company. You're taking on execution risk.
Like, is the CEO going to make a bad deal?
Or is there a labor strike in Peru? Or geology risk, right?
Yeah.
Like, oops, we dug a hole and there was nothing there.
Exactly.
With the iShares Silver Trust, you just eliminate all of that. The fund holds 100% of its assets in physical silver bullion. No debt,
No.
no leverage. It's a pure play on the price of the metal.
So it's basically a warehouse receipt. You own a slice of a giant pile of silver sitting in a vault somewhere.
That's a great way to think about it.
But tell me about the moat, because usually when we talk moats, we mean like a tech company's ecosystem. How does a silver ETF have a moat?
In the world of ETFs, the moat is pure scale. It's just gravity. The iShares Silver Trust has $23.3 billion in assets under management.
23 billion. That is a heady bag of silver.
It is massive. And that scale matters for a very practical reason: liquidity. When a fund is this big, it tracks the spot price super tightly. It creates a liquidity advantage that smaller competitors just can't match.
So investors flock to it because it's the standard.
It's the standard. If you're a big institution, a pension fund, and you need to move $50 million into silver by lunchtime, you go where the liquidity is. You go to this fund.
So it becomes a self-fulfilling prophecy. The big money goes there because it's big, which makes it bigger.
It's the network effect of capital. It just crowds out the little guys.
Now, I want to touch on the mood out there, the sentiment.
Yeah.
Because you can have the best fundamentals, but if the market hates you, the price won't move. Right now, though, the new sentiment seems overwhelmingly bullish.
It is. We're seeing a lot of urgency in the buying patterns.
Urgency is the perfect word. I was looking at the commentary, and there's this consistently positive outlook on hard assets. The belief is that the thesis is still intact, despite the volatility.
Right.
And here's where it gets really interesting for me. Silver is currently the only precious metal trading higher in the immediate window.
That decoupling is vital.
Right. Gold's been choppy, platinum's doing its own thing. But silver is signaling specific momentum. It's acting like the leader of the pack.
And when the high beta asset, which silver usually is relative to gold, starts leading, it suggests a risk-on appetite in commodities. It means traders are looking for aggressive returns, not just safety.
Absolutely. But look, you know how this works. I can't just let you paint this rosy picture. We have to look at the dark side.
The bear case.
The bear case. Because 148% returns are great, but trees don't grow to the sky.
Let's break that down. The first thing we have to address is the cost of holding this thing and just the reality of the volatility. We call it the volatility trap.
Yeah, let's get real about this. We mentioned that 30% correction as a buying opportunity, but living through that hurts.
It is vilest.
If you put 100 grand in and suddenly it's 70, that's a bad month.
Silver has a nickname in the trading pits: the Widowmaker.
Okay.
For a reason. While the long-term trend is up, the ride is just incredibly jagged. In this asset class, a 30% drop is considered healthy.
Healthy. That's a nice way of saying terrifying.
Statistically, it is. It clears out the leverage.
Yeah.
But for an investor's psychology, you need a stomach of steel. You have to be willing to see a third of your position's value evaporate and just trust the thesis.
And the volatility is high right now.
It's elevated, yeah. We're seeing these wild swings right after new records are hit. It's not a smooth ride. It's a roller coaster without a safety bar.
Definitely not for the faint of heart. And then there's the other risk, the one people forget about when they see those triple-digit returns, the dead money risk.
This is so important, especially for long-term holders.
We have to remember the downside of holding physical metal ETFs. The iShares Silver Trust isn't a charity. They charge you a fee.
Yep. The gross expense ratio is 0.50%.
50 basis points. So you're paying 0.5% a year. And what are you getting paid to hold it?
Nothing.
Zero. The dividend yield is 0.00%. There's no cash flow.
That is the negative carry.
Can you explain that concept? Negative carry.
Sure. Think of it like buying a classic car as an investment. You park it in a garage. It doesn't pay you rent. In fact, you have to pay for the garage, insurance, maintenance.
Right. Cash is leaving your pocket.
Every month. That's negative carry. The only way you win is if the car's price goes up more than what you paid to store it.
So if the price of silver just stays flat, if it trades sideways for a few years,
you lose money. You're bleeding 50 basis points a year, plus inflation. You are paying for storage, not getting paid to own it.
So you really, really need to be right about the price going up.
Exactly. You need that capital appreciation.
Which brings us to the macro risks. We have to widen the lens. We're talking about a global commodity, and when you do that, there's always one elephant in the room.
China.
The China factor. How big of a risk is this?
It's significant. China is the largest consumer of industrial metals in the world. They dominate solar panel manufacturing. So you have to consider the risk of, policy reversals or just a big economic shift over there.
So if the Chinese economy slows down,
If their economy slows way down, or if the government decides to change its policy on strategic reserves, that could crash commodity prices overnight. If industrial demand from China just evaporates, silver is going to suffer.
and history gives us a warning here too, right? We've seen these kinds of rallies before.
We have. And post-rally moderation is very, very common.
Mm.
If you look at the long-term compound annual growth rate, the KGR for silver, it's historically been around 5.9%.
5.9, that is a heck of a lot lower than 148.
It is.
Yeah.
We are multiple standard deviations away from the mean right now. And in markets, mean reversion is one of the most powerful forces there is. Gravity eventually wins.
So we might be borrowing returns from the future.
It's a real risk. We might have squeezed 5 years of gains into 12 months.
Okay, so a massive bull run driven by tech and fear on one side, and a potential mean reversion trap on the other. This sets the stage perfectly for what we need to watch right now.
Exactly. What are the triggers for the next 30 days?
We call this segment What to Watch. And for me, looking at the charts, the first thing is the price test. We are right there. Silver is testing $80.
$80 is the line in the sand.
It feels so psychological, doesn't it? That big round number.
It's psychological and it's technical. Breaking that level could trigger the next leg up. All the traders, all the algorithms are watching that level like hawks.
So a definitive close above 80 could bring in a new wave of buyers.
It could unleash a whole new wave of momentum buying. Yeah. It becomes a breakout trade.
But technicals don't happen in a vacuum. They usually need a catalyst. And that brings us to the macro catalyst we need to watch, the NFP report.
The non-farm payrolls. The monthly U.S. jobs report.
Why is a jobs report the key for a metal? Connect those dots for me.
It all comes down to the U.S. dollar. Silver is priced in dollars, and they typically move in opposite directions. A strong or weak jobs report dictates what the Fed does, which dictates the strength of the dollar.
So if the jobs report comes in weak,
If it's weak, the market thinks, uh-oh, recession, or the Fed have to cut rates. That weakens the dollar. And when the dollar gets cheaper, it takes more of them to buy an ounce of silver. So silver rips higher.
and if the report is hot,
If the jobs market is just scorching, the Fed keeps rates high, the dollar strengthens, and silver could take a hit. That report could be the thing that sparks the breakout above 80 or rejects it back down to 60.
so watch the jobs number. Okay, but I have to throw in one more thing, the wild card, the rumor mill.
I think I know where you're going with this.
I've been seeing some chatter in the options market. There is speculation, and I want to stress, folks, this is speculation, about silver hitting $200 later in 2026.
$200.
200. That is more than double where we are now. It sounds insane.
It is an aggressive target, let's be very clear. But let's ground it. It's unconfirmed, but it explains why the options market is heating up. We're seeing people buying call options at strike prices that just seem impossible.
They're buying lottery tickets.
Essentially, yeah, they're betting on a squeeze.
Yep.
The silver market is actually pretty small compared to, say, the stock market. If enough money rushes in, and if physical supply is as tight as we think, you could see the paper price have to chase the physical price way higher.
The moonshot scenario.
That's the one.
Yeah.
It certainly keeps things interesting.
So let's wrap this up. Let's bring it home. What is the lowdown on the iShares Silver Trust?
It's the heavy hitter. It's the go-to for direct silver exposure. It has massive liquidity, it's riding a huge secular wave, and it gives you pure ownership of the metal without the risks of a miner. But it charges you a fee for the privilege, it offers zero yield, you are paying rent to hold your money, and you are strapped into a roller coaster that can drop 30% without even blinking.
So you have to really believe in the thesis. You can't just be a tourist here.
No tourists allowed. You need conviction.
And that brings me to my final thought for today. We live in a world where everything is becoming digital. Money is digital, art is digital. Valuations for tech companies are based on these intangible things like network effects. We're valuing air.
Right.
In a world of digital assets and intangible tech valuations, is the volatility of a hard asset like silver a bug? Or is it simply the price of admission for the only thing that can't be printed?
That is the question every investor needs to answer for themselves.
Think about that. Keep your eyes on those charts, stay curious, and we'll see you on the next one.